Hi, this is Parag and I'm going to be the group lead for the strategic case analysis for Tesla. We've read through the entire case, and before we dip and dive into the partnerships, the numbers, the global market for electric vehicles, I would love to introduce my team and what parts they're going to focus on. Kelsey is going to focus a lot more on the global side of things and how the demand of electric vehicle was growing, and she's going to come right after me. And then Gabe and Ben are going to talk about the partnerships Tesla has had over the course of their success, failures, rides, bumpy rides, and all kinds of ups and downs Tesla has faced. And then I'm going to talk a lot more about the financial statements in terms of income statement, and then Jack is going to jump in and will make his suggestions on the numbers and path forward for Tesla by looking at their balance sheet. Now, before we go deeper into the history of Tesla as a company and the operations by Elon Musk and its partnerships throughout the course of time, its numbers, its financial statements, it's worthwhile to really learn where it stands today as of the report. In January 2018, Tesla was a key player in the global luxury automobile industry. Unlike 2015, 16, or 17, 2018 was the year that made Tesla, way more than just a niche market, niche industry, or car makers, so to speak. It now is producing, Model 3. It's much touted sedan, and on a mass level, that really changed the perception of people about Tesla, that Tesla isn't just some niche market that is just trying to cater to certain individuals who would prefer more like an early growth or early adopters. It now is moving forward to become a lot more mature company that would speak to a wide range of customer segments. Now, in terms of global vehicle industry, most of the industry up until 1973 was heavily reliant on internal combustion engine or ICE. That was really the dominant technology starting 1879 by Carl Benz. After that, as I said previously, in 1973, the cartel members, OPEC members, imposed an oil embargo against the United States. That really made many people thinking that, hey, this is the high time that we should try to come up with a technology that is not heavily and solely reliant on coal, so that people or cartels like OPEC can control, and automobile industry impacts a lot of other industries as well. So that was a cause of concern. And another good thing that really came out of this was Toyota Prius.
We are starting to see a very large increase in demand for electric vehicles here in the United States as well as in other countries, specifically in China. One of the big competitive advantages that Tesla has over other car manufacturers is its R&D, its research and development that they have put into play over the past few years. They also have taken a lot of different partnerships for a lot of the different manufacturing aspects of their parts to go into their vehicles, such as their batteries or their charging stations. The electric vehicles are also in high demand right now, especially in other countries. Like I said, in China, they had sold 4 times the amount of electric vehicles in 2017 than were sold here in the United States. And this is over $1 billion in sales. There's also many government policies that are going to be put into play or that are already in act that are going to start making car manufacturers have less emissions and greenhouse gases. So this is also a way for that market to grow. And Tesla also likes to sell direct to customers, which in some states that has had backlash, but it has also been proven that it's easier for the customers to come directly to them to look on their website for their cars. They're able to design their own cars. They're able to select all the features that they do or they don't want when they're shopping for their vehicle as well.
Before we move on and provide the solutions and all the strategies for how Tesla should move forward with their partnerships, Gabe and Ben are going to talk a little bit about the history of partnerships Tesla has had and the key partners they've had in making their road to success a little less bumpy.
Looking at the history of partnerships and the partnerships that Tesla had in general, in the early 2000s, they didn't have much, but they outsourced a lot. The three things that they did handle were the research for the internal combustion engine. They handled their sales and marketing, and they also had an assembly line for their products. In 2004, they had a key licensing agreement with AC Propulsion to kind of kickstart the production of their electric cars. And in 2005, with Lotus Engineering, they licensed lots of technology for the Roadster that they're still working on today. And they also contracted key engineers for the manufacturing department.
Additionally, the U.S. Department of Energy partnered with Tesla in January of 2010. They provided $465 million of a loan to Tesla, and Tesla was able to pay it off 9 years ahead of schedule. Also, Tesla, GM, and Toyota collaborated in the same year in 2011 with their United Motor manufacturing factory in Fremont, California. Toyota ended up investing $50 million for 2.5% of Tesla's company. And Toyota also paid Tesla $100 million to supply the battery, motor, gearbox, and power electronics for the RAV4. Later in 2017, Toyota sold its stake in Tesla, and it is perceived that Toyota received $478 million for its shares in Tesla. Another collaboration that Tesla has had in 2011 was their partnership with Panasonic. Panasonic provided 80,000 lithium-ion batteries over a 4-year span, and they also invested $30 million in Tesla stock in 2010.
This was not a partnership, but a key move that Musk made was they decided that all their Tesla patents to be open source. This kind of allowed the company to attract some of the world's most talented engineers to not necessarily work for them, but help aid their research in their vehicles. Looking at the Model 3 in 2016, Tesla announced that it'll come to market at a price of $35,000 in a range of 215 miles. By May, they had 373,000 pre-orders worth $690 million of money just sitting there. At this rate, Tesla had a 30% margin for the Model 3. And in 2016, there were many manufacturing partnerships and collaborations that were necessary for the Model 3. They also needed a lot of partnerships to manufacture the vehicle because of how many pre-orders that they had. They also needed a lot of infrastructure. In 2015, there were only 584 supercharged locations globally, and these locations are like gas stations for Tesla. It helps, and that's only globally. In 2017, Tesla aimed to have 7,200 supercharged locations around the world, and each location costs about $200,000 to make. And in 2016, Tesla spent $40 million in the production of these locations, which goes to show how necessary it was to have these globally before the Model 3 hits the roads. And to gain back a little bit of profit, they introduced a 40-cent per minute fee at each charging station.
So in order to achieve this vision for the Model 3, Tesla had to partner with multiple firms. So in 2016, they developed a manufacturing cluster around Tesla's production plant in Fremont, California. Some of the firms included in this partnership were Cypress Semiconductor Corporation, Method Electronics, AGC Automotive, South Bay Solutions, and Autodesk Inc. Additionally, Tesla entered a joint venture with Edison. They're a utility firm based in Ontario, California, and Tesla ended up building a 20 megawatt battery storage facility for them in Edison. While the amount paid was undisclosed, we can indicate that a 2 megawatt Tesla battery system costs around $2.9 million. We also see another partnership that was outsourced with Fuji Technica and Miyatsu Incorporated. These firms helped Tesla develop the design of tools to make the Model 3 possible, and this technology was able to shape aluminum sheets, which were in the past difficult to work with.
Looking at the key partnerships that we see fit, a lot of them were after 2007, and before in the early 2000s, they didn't necessarily have any key partnerships. They were just outsourcing a lot of their technology, which could come to bite them as it did when they needed to really produce the Model 3. So then when the Model 3 production came around, this is when they started to get key partnerships that would benefit both companies. Going forward, key relationships that we see fit are relationships revolving around enhancing the battery. They have taken care of a lot of infrastructure, and now it's only going to benefit them if they look at the battery and kind of enhance it to where not only can it last 215 miles, but more. So charging it less, we feel as if that's going to be key into getting more sales.
Now that we've learned a great deal about Tesla and its partnership with other companies, I think it pays a lot of dividends to talk about the guy in charge, Elon Musk, how he was, his previous ventures, and how he operated around people. So I think it's great to learn his humble beginnings and how he came into foray, so to speak. So Tyler is going to talk about Elon Musk, the guy in charge.
Elon Musk is from South Africa. He obtained a dual degree in physics and economics. He abandoned his doctorate program 2 days in to co-found Zip2 with his brother. Zip2 is an online city guide and mapping firm. The key to Zip2's success was Elon's ability to obtain the navigation software for free from a company called Navtech, who created GPS products. Musk invested half of his $22 million gain into X.com. X.com is an online financial service company. X.com merged with Confinity, who had a new product called PayPal. When the company started losing money, Musk was outed as the company's CEO. Elon stayed on at the company as an advisor and increased his stake in the company. When PayPal was bought out, Musk invested his $250 million share into SolarCity, SpaceX, and Tesla. Musk helped lead bring Tesla from a simple concept to a luxury car company. SolarCity leased power systems to homeowners. SpaceX had contracts with the government to cover payloads into space, to launch payloads into space with their rockets technology. Musk was a great entrepreneur as he ran the three companies. He recognized a problem in which he felt he could solve with Tesla Motors. He states that the overarching purpose of Tesla Motors and the reason I am funding the company is to help expedite the move from a miner and burn hydrocarbon economy towards a solar electric company, which I believe to be the primary but not exclusive sustainable solution. Therefore, the problem statement is how does Tesla move the economy towards a more green and sustainable one? Musk's solution was to sell directly to consumers. Musk believed that there will be little to no opportunities for business growth if they were to sell their cars to dealerships. This is due to the lack of access to customers' reviews and lack of expertise from salesmen about electric cars. Musk decided that Tesla should be sold in company-owned stores. The stores were placed in high-traffic areas to attract open-minded buyers. Tesla also partnered with Nordstrom Inc. with the idea that they can get more customers because Nordstrom Inc. customer base was similar to the demographics of the person who would buy a Tesla. Location and partnerships are just two ways that Elon Musk and Tesla have identified and strive to tackle the problem. The goal of the company is growth, and in order for Tesla to grow as a company, they must be innovative in their solutions.
Now that we've learned a little bit about Elon Musk and how he likes to operate, I think it's time for us to really understand the numbers, especially the last 3 years of numbers that are provided in the case. I think numbers tell a story. Of course, the case itself is a sort of a fact pattern and a wonderful way to read it as a story as well. But I think it pays dividends to also understand how the numbers worked in Tesla's case. So if you look at the income statement to begin with, on Exhibit 3, if you look at relatively considering all those roadblocks, Tesla did fine in terms of its revenues. But if you go down and if you take a look at the gross profit that it made, which still, in my opinion, is a pretty decent profit considering the industry they were in. But what it really paid a lot of money out and cash burn, so to speak, was their operating expenses. They were investing heavily in their R&D, and there was so much money at stake in terms of how they wanted to differentiate themselves as a whole different market segment, sort of like a blue ocean, because they didn't want to dive in the red ocean where, they were cutting each other's profit margin just because they were super competitive. It looked initially that Tesla was losing a lot of money because they were investing so much in their business or into developing their business. So that's where most of that money comes from. Loss, I should say. That's where most of the loss comes from. Their net loss at the end of 2015 was $888,000, which is not something to be super concerned about, at least initially, because Tesla was still a startup at the time. So I'm sure the investors at the time were not super bothered because Amazon and Facebook and Uber, all other startups were following the similar model. Most of those startups didn't make any money for the first 7-8 years. So investors weren't super concerned because as long as they were sold on the value proposition, they seemed to be getting along just fine. Now, if you make a stark comparison between the income statement or net loss between 2015 and 2017, you would just be surprised whether it's the same company or different one. Yes, I mean, as time went by, Tesla started investing a lot more in their research and development, and they were trying to ramp up the production numbers for their Model 3. So that of course impacted their loss or cash burn a great deal. But beyond that, I think one of the major issues at the time were their gross profit wasn't quite as good compared to their 2015 number. You would think with total revenues of 11 million and some change in 2017, you would think they would at least have some gross profit of at least 25%, but their gross profit was not even close to that. So compared to their 2015 numbers, their gross profit was you know 25% almost. So R&D, of course, there is, they were trying to ramp up the numbers, but their revenues also, stalled in 2017, which caused, their stock price and everything to really dwindle, and investor confidence in Tesla and Elon Musk also started to dwindle a little bit.
Now let's look at some of the financials provided from this Tesla case. Now, at first glance, from some of the statements provided, it would look like Tesla did fairly well from 2016 to 2017. After analyzing the balance sheet, we noticed that their assets increased by 25% from 2016 to 2017. However, after a more detailed run-through of this financial statement, we find that in all actuality, all that changed under this asset column is that Tesla took out more notes and bonds from banks in exchange for increasing their property, plant, and equipment. And from 2016 to 2017, Tesla's cash actually went down. So in all actuality, Tesla just simply took out more debt in exchange for more basically equipment that they cannot use due to a battery shortage during this time period. I think this is a very inefficient decision by Tesla. I think moving forward, they need to find a way first to be able to profit from each vehicle sold. The fact that they're not turning a profit means that moving on, their cash will continue to go down and down until they don't have any more liquid assets to spend, and they'll have to file for bankruptcy. The short-term solution to this would be, due to the battery shortage, Tesla has not been able to reach their goals for production from quarter to quarter during the 2016 to 2018 period. So what I suggested was that they simply increase the price of these vehicles. They have hundreds of thousands of people with orders or wanting to place orders for these vehicles, and Tesla is already a premium product up there with BMW and all these other electric car companies. I think it would be very foolish of them not to increase the price per vehicle with this increased demand and limited supply of the vehicle. The fact that they are not turning a profit is probably the biggest red flag after looking through these financials. And second, moving forward, we need to analyze the fact that after we already spoke about the income statement and the fact that this is supposed to be a growing market and it is expected to 4x in the next 10 years, I think that increasing the plant and property is not a bad idea, but we need to think about short-term goals more than long-term goals at this point. It's great that they're planning 10 years in advance, but if they're not going to have the funds to last 3 more years at the rate they're going, then what is the point of setting those 10-year goals? So I think their goals and plans are somewhat realistic for the long term, but they also need to analyze how much this is hurting them in the short term.
Thanks for that, Jack. So it really brings us to the bottom line of what Tesla should do. Even though we understand as a team that we're sitting in future, we know a lot more about Tesla than we did back in 2018 or back when this report was published. But if we just stick to this question of, what types of partnerships at the time were needed. And if I just forget for a second that I don't know anything about Tesla in the past 3 years or so, I would just say that just because 2017 was a super bumpy ride or super bumpy road for Tesla does not necessarily mean that its model was not working. So as someone who believes in blue ocean strategy, and as the Tesla being the company that is a perfect epitome of blue ocean strategy, just like Cirque du Soleil, we would still think that Tesla would still need to continue to partner with the way they have been doing it, as Ben and Gabe said. But at the same time, they need to be careful about certain partnerships that they should avoid. So it's For them, it's more of the matter of who not to partner with versus who to partner. So if they go with that strategy, because one of their ways that they went around getting better and better talent was making the software open source. That is one way to do it, and I think that's a brilliant way to do it. But at the same time, Tesla should retain some of its out of the box thinking. So for them to really do that is to define or redefine themselves and reposition themselves to how they started the whole, concept of electric vehicle or even autonomous vehicle in today's age. I think they do need partnership, but they just need to find a way. One way I can see after reading the whole case is to really work with other so-called rival companies to come up with a charging network. Though Tesla prefers to have their own charging networks, it would pay them good amount of goodwill and less customer hassle and less worrying about the operating costs from supercharging and whatnot. So one way they can partner and go around the rivals who are popping up every day because they have the capital, they have the connections because they've been there forever. Tesla is still a very new company. So is to somehow come up with a way to partner with even rival companies, just like how it did back in the day with GM and Toyota and Panasonic. I don't think there was anything wrong with that kind of partnership, as long as they're not shying or so to speak moving away from their ideology of making Tesla blue ocean. So that could be one way for them to proceed, is to build a network of charging stations in partnership with other automobile or electric vehicle companies, so that there is a network for anyone can charge, from anywhere, as long as it's an electric vehicle.